My name is Edward Peghin, and I practice actually as a concierge lawyer. So I try to give um, special attention to clients. We're basically from beginning to end. I'm your sort of point of contact, and that's the kind of service I aim to give. And I have a team behind me, and that's we work together to provide um, very catered services in media, startup, and tech. So my background or my perspective on cross-border media financing strategy and sort of things based on many years of practicing law, as well as decades of business strategy and working directly in the creative industries in both Canada and the US, as well as in Europe and Asia. I've been involved in many international treaty co-productions for television productions. And today, or this evening, what I'd like to do is um, explore with everyone the mechanics of cross border media deals and the underlying forces that are shaping the current entertainment landscape in the US and Canada. This is a very interesting time. There's a lot of opportunity, of course, right, with streaming. Needless to say, gaming. There's incredible intersection in the entertainment model, and so uh, along with this, there's also quite a bit of complexity in terms of business structuring, legal implications of finance deals, and how you can split up the rights, and how whether you're an investor or whether you're a creator, how those rights can be exploited and who can benefit from them and how. Um, Financing pressures are tightening right now. Traditional models are being disrupted by streaming platforms. Hence, the claim of the death of cable TV or regular terrestrial television. Um, and so this disruption, and also, of course, audience viewing habits are really changing. And so, on top of this, governments are grappling with regulation. What gets regulated? How does it get regulated? And how does all this, so these new viewing tendencies, these new platforms, how does all this affect financing and the ability to extract profits from exploiting um, the intellectual property? So, complexity, frictions, challenges, yes, but opportunity, absolutely. Incredible opportunity where, we have companies like Mr. Beast, valued in the hundreds of millions, $1 billion, right? So these sorts of things up until now have been unheard of. So the idea with this presentation is to really look at um, uh, providing a high level understanding of cross border production. And that can be media in whether it's television, film, online, gaming, um, sports, as sports are connected to viewing rights, that sort of thing, broadcast rights. So if you're a financier or in finance and interested in media financing, we're going to have a sort of a high level view here on whether your production, you're looking at financing large scale productions like a suite of productions, finance getting behind a studio, whether in the US or in Canada, creating a new studio production house, or whether it's just a single one-off production. A lot of the laws are the same, of course, that govern these things, and a lot of the strategies and techniques for financing are very similar, regardless of the scale of the production. Are there any questions at this point in terms of starting off? Okay, so few things I want to touch on. So the state of the industry now, which is critical, uh, um, cross-border financing, regulatory realities, challenges, opportunities, and then takeaways and discussion if we have time and people have interest. So let's go on to the state of the industry. So essentially, we have two quite different media landscapes in the US and Canada. A lot of the cross border financing that we tend to talk about is US financing productions that come into Canada. Of course, there's Canadian content that gets exploited for the US, but generally the move is from the US to Canada just because of the amount of money and just the influence, cultural influence in general. So these two different perspectives, these two different playgrounds are quite different, and they're going to determine sort of um, how projects get financed and how they get distributed. So, to understand the legal and business dynamics of cross-border entertainment deals, we have to understand overall the fundamental differences between US and Canadian media landscapes. So the US market is vast, uh, very privately driven, with major players competing in a largely open environment. Sure, there's regulation, but the regulation is different than what's driving regulation in Canada. Because Canada's ecosystem is so much smaller, tends to be a little bit more centralized and controlled by the federal government. There are significant forces that are within the industry that are shaped by cultural policy and regulation. So, the whole idea behind Canadian content is to try and preserve, um, uh, what it means to be Canadian in our entertainment consumption. So, arguably, there's a certain amount of protectionism, right, in Canada, and that's why we have CanCon and the CRTC to protect from. I mean, protection is one way to look at it, but it's to allow Canadian productions to thrive, right, as opposed to being taken over by the U.S. And this is a common thing internationally, a common theme. There are many countries like Canada where the economies are smaller. There's a desire to maintain a certain amount of uh, um, cultural um, uh, protection, maintain culture. And so there are a lot of treaties where countries other than the US can join together to take advantage of tax credits and various government funding mechanisms that don't exist if the US is involved. So, how do these um, differences play out in today's digital marketplace? So essentially, probably the most important battleground. Again, it's I hate to use military terms, but essentially, it's there's some serious competition here, and it starts with connected TV or CTV, and connected TV is essentially on-demand streaming video. It The most popular, most important type of connected TV is free ad-supported television, like Pluto and Tubi. Sorry about my dog, everybody. Pluto and Tubi. So people are willing, or consumers are willing, to watch free streaming on demand TV with commercials. So it's very similar to traditional television, except that now it's on demand. You don't have to wait for a certain hour of the day to watch your show. So Pluto TV, Tubi are huge. In the US, a little bit slower to be adopted in Canada, just because we have a smaller advertising market here, which means less revenue to run these free shows, and also stricter broadcast regulations. Again, Canadian content, essentially. So Canadian broadcasters and streamers in Canada still have to operate within the framework that prioritizes Canadian content, which is called CanCon. And that limits foreign ownership and also determines how much non-Canadian content can air on TV or streaming during the day. Um, to give you an idea of just how significant streaming is, you probably all know or have heard about the Amazon Roku alliance that was announced this year. So basically, you have these two giants, Amazon and Roku, getting together, combining their resources, essentially advertising inventory using Amazon's demand side platform. So essentially, what Amazon and Roku are doing is they're getting access. Now, these are non-traditional broadcasters, right? So you have Amazon and Roku playing now in a pool of 80 million US households where they can deliver product, uh, TV shows, and we'll get to this a little bit later, but they can be branded TV shows. They can have product placement. So again, it's all about the advertising and the marketing. And so this is one of the new changes that has occurred. This kind of scale right now is not possible in Canada. We just don't have access to that many households through streaming, and there's no single company that has tied up that kind of advertising inventory. It's probably coming, but it'll likely be a while. And how does Canada deal with this? So Canada not only consumes but also produces content, and so companies may have to partner with U.S. companies somehow or U.S. networks, and to sell into the U.S. may have to integrate into U.S. networks. So this leads to challenges and potential complications, right? Trying to tap into this sort of massive market, but that's driven essentially by companies that have immense wealth and therefore immense power and even political power, arguably. So all this, let's see here, pardon me. So all of this has resulted in financial pressures and leading to the beginning of market consolidation from the perspective of the original powerhouses of film and TV. So the studios like Warner Brothers, Disney, MGM in the US, right? They're all now looking for ways to compete with like Apple TV, Amazon, Roku. So these are the financial pressures that they're experiencing. And the result is a type of consolidation or reconfiguring of their channels and how they distribute, right? So the explosive growth of streaming platforms over the past decade was fueled by essentially cheap capital and a race to acquire subscribers at any cost. So it's kind of like, kind of like I guess the AI craze now, just dumping in as much money as possible, and again trying to get subscribers, or people using your product, no matter what it costs. Right? Don't need to see an immediate return. However, um, that's changing. That there's still growth in streaming platforms, but of course, money isn't as cheap as it was several years ago. Right? Interest rates have risen. The market's becoming saturated, and investors now want profitability. It's like, okay, we've been waiting around now for many years. right? It's time to see some kind of profit. We want to see some kind of payout. So the streaming boom, the boom is over. Streaming is not, of course, but there's a rebalancing now. And so what we're seeing is, for example, Warner Brothers Discovery and Disney have trimmed or cut back on their content spending. They've canceled projects to focus on profitability. Now, Netflix is the exception, but Netflix also has had a different model for the last, 30 years now. It continues to increase its content budget, but it works for Netflix because that's how Netflix continues to bring in subscribers. It's not that model doesn't work for pretty much everybody else. And that's why we see, again, consolidation, cutting back on a number of channel offerings. For example, in Canada, Bell Media has laid off many staff, closed MTV Canada. All of this reflects broader cost cutting across the Canadian broadcast sector as well. Um, I don't have to go into the details, but generally we have it's become it's being viewed more as a serious business now where investors expect a return on their investment. So let's see. So that gives you an idea of the state of the market now in Canada and the U.S. There's sort of a bit of belt tightening. The opportunities are still huge, though. That hasn't changed. It's just kind of, reconfiguring how do we deal with certain realities as they exist now, right? With uncertainty, global uncertainty. Okay, let's go to cross-border financing and co-production opportunities. So, actually, before I go to this, are there any questions? Hmm. Okay, great. So basically, Canada, let's talk about Canada as a cross-border opportunity. So let's say you have money, you're a U.S. Financier, U.S. based financier. There's a fund there. You want to make movies or TV shows or some kind of streaming product, and you want to do it in Canada. So there there are many different ways, but one of the most common is through tax incentives. So if as a U.S. entity, if you're only funding in Canada, there are ways to take advantage of creating a structure in Canada, partnering with a Canadian production company, and depending on the Canadian content rules, the amount of Canadian content, the production can attract up to a 50% uh, uh, refund or rebate, cash rebate on labor. So, your the $2 million or 5 million or 10 million that you spend on labor in Canada on that production is now worth 50% more, uh, and that doesn't account for the exchange rate. And that's simply through having following Canadian content rules. If it's a non-Canadian content production, there are still tax credits available, which can be used to fund up to a third of the production. So, through tax incentives, what happens is essentially is whoever controls the production, the producer, um, and the funder is the investor, essentially. Um, through these tax credits, you can actually go to the bank. You can go to RBC and get your letter from your lawyer or your accountant that says, okay, we've done a review of the production, we've looked at the budget, we've looked at the financing, we can see how money is being spent on labor, and we can tell you that we're expecting, $5 million, a $5 million rebate from CRA within, a year or so after the production is completed. And you can take that money to the bank, literally, and RBC or another bank will fund, between 80% and 90% of that tax credit, which can be used towards either funding the production or um, as returning it to the investors, right? So it's like funding 100% of a production and immediately getting back 30% or up to 50% of what you've invested. So that's a great way to either increase your budget or um, maintain whatever budget you have and decrease your spend. So thereby really reducing risk. Another way is through treaty co-productions. The U.S. cannot take part in treaty co-productions. They exist for pretty much for every country except for the U.S. And part of the reason is, again, each country is trying to protect its own film business and also to promote each one country's trying to promote its own culture, right? So for example, Canada can have a treaty with France. It has a treaty with France. I worked on a treaty co-production with France many years ago, and the way that works is um, both Canada and France are recognized as official um, producing partners that qualify 100% as um, uh, producers within their own country. So a Canadian producer who's working with a French production company, the Canadian company can take full advantage of Canadian content requirements. So whatever the spend is in Canada, it's as if all that qualifies for Canadian content. Whatever the spend is in France, all that qualifies for the French spend and all the tax credits. Again, up to 50% in Canada. I'm not sure what the amount is in France these days, but significant. And that can go towards funding the production. So the way the US can get involved, however, so suddenly we have access to all these funds that are guaranteed to be returned to the producers by the governments. A US company can get involved as a financier or through distribution, where it distributes the product, whether it's streaming or whether it's TV or film, everywhere outside France and Canada. And so a US partner, quote unquote, can take part as long as they don't have overall creative control or financial control of the production. So that's another way for a US financier or funder to get involved in a treaty co-production. And again, reducing risk because you know that a certain percentage of the funds will be coming back to you as soon as the production wraps and it gets ready for distribution. So, in a nutshell, that's how treaty co-productions work, and that's how outside the U.S. that's how most productions get funded. If so, through tax credits and then government grants, of course, Telefilm, the Canada Media Fund, and all countries outside Canada have very similar sort of government agencies and tax credits.
Edward, before we
Yes,
go to the next page, there are a few
yes,
questions. I don't know if
yes.
you'd like to take them now.
I'd love to.
Yeah. So, do you see them there? Can you clarify what the cost would be which cost would be eligible for the rebate, and also if
Oh,
yeah.
yeah. Sure. So that's a great question. That's it's getting a little bit more detailed, but basically, or generally speaking, the tax credit is on the labor spend, right? So whatever is spent on crews, technicians, um, above the line as well, directors, screenwriters. So any labor component attracts the credit on the federal level. There are two levels, right? There's the federal, and then each province and territory has its own rules around tax credits, and the amounts differ. So in Ontario, it's also not just labor, but it's also certain qualifying goods and services. So certain types of equipment rental. Um, um, uh, that's probably the most significant one, but there are services that also qualify that go beyond the employment.
So basically, what states in Canada or in Ontario, and there are two layers, the federal one and also the Ontario one, and one
Yes.
can ask for credits both at the federal level and at Ontario level.
Yes.
Then the next questions on the same line is if work is subcontracted to the local production companies, who is eligible for the rebates, or can they be stacked? Because usually more companies would work on a production. Perhaps you can address that.
So ultimately, all that matters is your total spend, right? So if you have multiple subcontracting companies, um, CRA is going to be looking at, well, I mean, and also, I mean, ultimately it's up to CRA, but the province or the territory and the federal government are going to be looking at who ultimately is that money being spent on, right? So it doesn't matter how many subcontractors you have. Doesn't matter whether it's a company or an individual, right? Ultimately, it's how many individuals, for example, if we're looking at employment, how many individuals have actually um, uh, benefited or worked for this money. Does that
So,
answer the question?
so Tim, perhaps you want to ask more questions as I'm not sure.
Uh, yeah, just if the rebate is on labor costs, does it have to be the whoever is paying the people directly? Because most of this is farmed out to subcontractors, right?
Right. Right. So everybody who so everybody who's a Canadian and is able qualifies for the tax credit, like they'll fill out a form, right? Um, and swearing that they're Canadian, that they worked on the show, and whatever they got paid can be used towards the tax credit. So it doesn't matter what level they're at within the company or companies.
So it doesn't need to be a central point that claims for this. Each subcontractor can claim for the credit, just that they have to be a Canadian company hiring people or renting equipment, or a US company that's hiring people can also claim.
Yeah, it's got to be, well, if we're talking about employment, it has to be a Canadian individual, right?
Thank you.
Right, because it's the tax credit is on labor.
Tim, would you have other questions?
Nope, thanks.
Thank you. So we have another question, Edward.
Okay.
So from Cynthia. Is Canada preparing for the US government proposed 100% tariff on foreign-made films that currently still remains a proposal but may be enacted in the future?
I looked into this just recently, and as far as there's not a lot of chatter about it. I don't know how something like that would truly go into effect. The two economies are so intertwined. I think it would be very, very difficult to execute on a 100% tariff like that. As far as I know, just from what I've read, there's no. It does not look like it's going to go ahead.
Cynthia, would you have additional questions?
No, that was it. Thank you.
Thank you. So I also have a question. Assume an advertisement by a head office in the US, for example, Xerox or Staples, produced in Canada, would make sense financially to use the Canadian subsidiary to produce it, even though it's distributed everywhere in the world?
To
Meaning if
produce what?
there is any financial advantage.
To produce what? Sorry.
An advertisement.
So, yeah. So these, for example, these tax credits um, would not apply to advertising. For example, these are for scripted or unscripted shows, whether they're streaming, whether or
Features.
with theatrical release or regular television. Advertising is excluded. Pornography is excluded. There are a bunch of other exclusions as well.
Thank you. Are there any other questions?
Could I ask one not through text?
Sure.
Sure.
Okay, because it might be faster than me just typing it out. So in terms of AI regulation, are there any differences in the approach that each country is taking that might throw some curveballs into how deals are structured and what's possible?
That's a great question. And the answer is we don't know. It's the Wild West right now. What we do know is that both in Canada and the US, um, and I don't know how directly this answers your question, but right now, in order, for example, to own the copyright in an AI produced work, there's got to be a minimum amount of human um, input with that product, right? So the AI itself cannot own the copyright. That could change, but for now, that's the rule. So AI essentially, and that's important, right? Because we're talking about the exploitation of intellectual property, and we have to know who owns it, and that's obviously extremely important for investors, which is a topic I'll get to a little bit later, because not only do investors have to feel 100% confident that what they're investing in, the entity they're investing in, owns the copyright and can actually exploit the product, but there's all the derivative rights, right? So merchandising, sequels, prequels, all kinds of spin-off music, right? So we need to be 100% confident in who owns the rights. So I think right now it seems that as long as there's as long as there's a substantial human um, input, then it's the individual that will own the copyright. So our due diligence needs to go a little deeper now when we're investigating whether something was created purely by artificial intelligence, or was there a person instructing that algorithm, to know for sure if there is any copyright in it. Because if it's just done by AI, then presumably there's no copyright protection. I don't know if that really answers your question. It's just such a wide open area right now.
Yeah, I mean, it was intentionally open-ended, so it was very insightful.
It's definitely a fascinating area, and it's something that we all have to look at very, very carefully if we're doing, well, especially if we're doing any sort of financing,
Yeah,
on any sort of deal.
I know there's been a lot of articles on how it impacts the film industry in general, but I haven't really seen much other than this discussion about the cross-jurisdictional implications.
Well, and that's interesting because Canada and the US move at different speeds, right? With interpreting the laws. just based on my experience, Canada tends to lag a little bit with, the US tends to sort of be the mover, the more experimental when it comes to um, innovation, right? Canada tends to be historically a little bit more conservative. So we could be in a situation where the laws have adapted in the US to deal with artificial intelligence, but they haven't adapted in Canada, right? Uh, or to the same degree. And that could cause a problem, especially for cross-border. But even if it's not cross-border financing, for example, if it's even just distribution, international distribution, does the product that's being distributed throughout Europe have the same protections that, when being distributed in the U.S. or in Canada or in Africa or in Asia, right? Like even now, that's an issue because not all copyright is aligned throughout the world. But I think AI will definitely make it even trickier.
Are there any other questions at this point? Yeah, I think we can go to the next slide.
Okay, great. All right. So let's see here.
Yes.
Okay, so we can talk about streaming. So it's the same. Streaming sort of has the same issues, or looks at the same issues that traditional distribution models or traditional delivery platforms had. And that's basically, if you're creating content as a producer, you want to hold on to as many rights as possible. The funder will depend. If you're funding it, then you also obviously want to hold on to as many rights as possible. Now, distributors. So there's if the producer is not also the funder, we've got a conflict, right? Because you've got the parties. The parties are the funder, the producer, and then generally speaking, and then you've got the distributor, and each one wants its own piece of the pie as much as possible, right? So the things that we have to look out for is how much of those rights are being given up. So with streaming, there's a lot of buyouts. So if I'm a producer and I'm working with the funder, we essentially we want to get a product out. It's very competitive, and there might be a tendency to take a nice payday because the money seems great. It's like, yeah, let's do it. We're good. The distributor's going to pay us this much money or this much of an advance. And what happens oftentimes is that producers, and then unfortunately usually the financiers, if they're not watching carefully enough, is that they give up all the rights. Right? It's like a one-time buyout, but then the buyer of those rights, the distributor or either the international distributor or the sub distributors in all the different territories, can use those rights and can sell portions of those rights. So those rights are music, sequels, prequels, merchandise, clothing, toys, that kind of thing. And so these are the issues that are coming up again with the streaming model. So usually that's where a lot of the profit or money comes from. It's not that original sale of your movie, for example, or your TV series, but it's all the subsequent sales, right? Or it's spin-offs. And those we're talking subsequent sales. They can be like anywhere in the world, right? If it's a popular program, I mean, there's so many markets, and if you've just sold your property for that buyout, then everyone else now is going to be dividing up those rights and exploiting them. And essentially, you as a producer, you end up losing out on all that potential back end revenue. So this is something that financiers have to be very aware of: is what rights are being given up. What are, if a distributor, a global, like say an international distributor, offers your producer, say, $1 million buyout, is that really a great deal? Even if the program cost you 100,000, you're thinking, oh wow, 10x, wow, that sounds great. But with perpetual rights, international distribution, merchandising, you name it, I mean, it could end up for a hit that could be in the hundreds of millions, billions even, right? So that's all money that's lost. And so that's potentially lost, right? With the buyout. So these are things that we definitely have to be very cognizant of. And so I hope I'm not getting too ahead of myself, but essentially, a buyout is a financing structure where the platform, so i.e. the distributor, pays a one-time upfront fee for all rights, forever, everywhere, for everything. And it maintains residuals, back-end revenue, everything, right? So that's, and the result is that producers, and therefore the financiers, end up losing out on long-term monetization opportunities, like syndication. That was another one that I missed. International licensing, format adaptation. So very critical in not just cross-border financing, but just financing in general.
Ed, just
Yes.
cognizant of time, we have 12 more minutes.
Oh my goodness. Okay.
I don't know if people can stay a bit longer, but just to let you know. Thank you.
Well, this is really riveting stuff. Why would anybody want to leave? Okay, I'll go through this quickly, looking at just regulation, and I think the big one here that's really been in the news is Bill C-11, right? That although has come into force, is actually not being enforced. There's a bit of a respite or reprieve right now. So Bill C-11 essentially requires streaming platforms to pay into the Canadian broadcast system, just the way traditional broadcasters have to, right? So U.S. broadcasters, I believe, once the revenue, broadcasters with the revenues of $25 million or more have to pay, I believe it's about 5% of a certain amount of money of their revenues back into the Canadian industry. And so this has been very hot topic, very controversial, in the U.S. Netflix, interestingly enough, has decided that it's going to, is prepared for it, and has started increasing its investment in Canadian original content with Quebec-based productions. So Netflix has jumped on it. It's not resisting. It's assuming that this is going ahead. So that money that it's required to pay under Bill C-11 is Netflix is using that money to invest in Canadian product, which I think is fantastic. But it's still hotly contested and not being enforced. But that could have an impact, right, on cross-border financing. If it starts being enforced, there may be platforms that decide, you know what, we're just going to cut Canada off. We're not going to get involved. We're just going to cut off that source of funding. And that's going to impact on, the financier's ability to finance Canadian productions. Or you might be in the middle of financing a production when Bill C-11 starts to be enforced. Whether there's a grandfathering provision or not that protects the financier, who knows? But that's a risk. Do I think it's a very serious risk? Not really, in the overall scheme of things, and I'll get to that. Why I think that is. Then there's U.S. regulatory friction. So for Canadians wanting to get content into the U.S., aside from the competition, the difficulty in getting into that market, which is driven by other factors, regulation in the U.S. generally is not really a factor. U.S. doesn't have U.S. content requirements the way Canada does for Canada. And then, of course, there's some challenges. So these are challenges that we've talked about, and there are more challenges: artificial intelligence, intellectual property. How much more intellectual property is going to be, or the benefits of that intellectual property, the ownership of the products that are being created. What percentage of the exploitation, the revenues from that exploitation, are to be paid to the actors, to the directors, all the members of the unions and the guilds that have gone on strike, right? To get a bigger piece of the pie, to get a greater portion of streaming revenues. So these are all issues that are still being worked out. And now we have artificial intelligence, which is going to complicate things even more, and can also impact projects coming to Canada as well. If it becomes more expensive to produce a project in Canada, then producers and funders are going to look elsewhere, in Europe or in Asia, or maybe a different state in the U.S. like Georgia, that has really nice tax credits. So these are all factors, again, that I think are going to be challenges for funding projects and trying to extract a higher return on the investment. Infrastructure, well, that's not a huge deal right now. There is some limited capacity for visual effects, and by the way, visual effects for movies and TV shows, fiction, nonfiction product, also attract. Visual effects also attracts its own tax credit, which can be added on to our regular tax credits. So Vancouver and Montreal are real hubs for visual effects, and that's why you see a lot of visual effects being done in Canada. And of course, the exchange rate, I don't think it's a barrier. Sure, there's volatility, but there are ways to address volatility. Ultimately, you're looking at what has been traditionally, except for a short period, I guess in the 2000s, a favorable exchange rate, which brings projects here. Looming tariffs. Honestly, the tariffs, I think, if they ever were to be enforced, I think it would be a temporary thing. I don't think it's going to happen before this administration leaves in a few years, and I don't think this will ever come up again. It just doesn't make business sense whatsoever. There's the media is just, like I said, too intertwined. Canada, US, just too intertwined. There's way too much crossover for this to be a realistic fear. Opportunity. So this is why, if you're into cross-border financing or just media financing in general, I believe that we are in a completely entertainment crazy period that's been growing for decades and is going to continue to grow. People love leisure. People love sports. They love shows. And there are all kinds of different ways to create media with these, 20-second films, 30-second films, interactive films. Like the world of media is changing so rapidly, growing so rapidly. The choices for how we can entertain ourselves are endless. And so I believe that cross-border financing is here to stay. Is a viable way to make money if done strategically. And certainly, the favorable exchange rate, the tax credits in Canada, um, lower insurance premiums for sure for production, but also lower crew costs. Um, it's the future is very bright. I believe, um, even though we're in a right now it's a little bit uncertain, but in the long term, very very bright. And then there are many growth areas. Like I said, it's unlimited. Branded content, which is essentially just an extension of product placement, right? Where you put the Coke can or the Pepsi can or whatever in a scene, and it's obvious that the producers want you to drink Coke or drink Pepsi. Well, that's going further. I mean, it's not a new concept. It's just becoming more widespread, where you actually have brands like you can have Lululemon sponsoring a show, or any type of media, like whether it's kind of educational advertising, or it's a type of advertising but meant to be informative. So companies have been doing that, and we're going to see even more of that. Gaming, interactives, podcasting, AI, and virtual production. Watch out. AI virtual production is going to be out of control. Out of control. Great opportunity for investors. Okay. Cross-border media financing is evolving. Make sure you know what the deal terms are. Get your lawyer involved or whoever, your advisor, but just make sure as a financier, do not leave it up to the producer. Don't leave it up to anybody else. Make sure you know that what the terms are, to ensure that as a financier, you're going to be able to take advantage of as much intellectual property ownership as possible. And Canada, of course, is and will continue to be a fantastic location for all kinds of media production.